Good morning and welcome to this Monday, July 13th, 2020 edition of Trading Places Live at EarningsBeats. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, market looks like it wants to get off to a pretty good start this week. We did finish on a good note on Friday. Nice finish on Friday. All of our major indices did move higher. We did see a little bit of rotation. We've been seeing the NASDAQ leading for quite a while, probably back since, it's probably been a month or so since the S&P 500, I think, topped on June 8th. We've seen a lot of rotation back into many of those technology names. But Friday seemed to be maybe a little shift, and that's something to watch this week. We might see, because the outperformance of the NASDAQ stocks have been so great over the past month, we easily could see a little bit of rotation back into some beaten down areas of the market, some groups. We'll see. And we'll go over all that in just a moment. I do want to just let everybody know, if you are new to EarningsBeats, you can go into our website and sign up for our free EarningsBeats Digest newsletter. Just name and email address, no credit card required. You can subscribe. We have articles that are published Monday, Wednesdays, and Fridays. Pretty short newsletter, usually just a couple paragraphs and a nice chart. Focuses on education, mostly relating to earnings, relative strength. Sometimes we'll get into sectors or industry groups, talk a little bit about that. But if you look over to the right, you'll see that we have a pretty strong track record based on the things that we look at. We like to marry fundamentals with technicals. The technicals certainly are driving the action, but a lot of times we're only looking at the technicals of companies that have already produced great fundamentals. So I think it's a great combination. I think the numbers are backing us up on that. And so if you're new to us and you want to just kind of get a feel for how we approach the market, I think the best way to start is simply to just get a free EarningsBeats Digest newsletter. If you'd like to try our service, we do have a $7 30-day trial. It is fully refundable, so you'll get your $7 back in a few days. So you really have 30 days to try our service, no cost. The other thing I want to point out is tonight we are having one of our big events, which is our Q2 earnings sneak preview. So we make this one available to the public, so anyone can come in for this. Just looking, going to be looking at some of the numbers or some of the companies that recently reported, some of the better reports that have come out so far. Take a look ahead maybe for the next week or so. We got a lot of bank earnings coming up this week, some key transportation earnings coming up. We got Netflix coming up. I'll be going through all of those major reports, giving you my take on what I see coming up with these earnings. So if you'd like to check that out, just simply come back to our page, earningsbeats.com today, probably around 4 o'clock. We should have the room open. There'll be a link here. So once the room opens, we'll make sure you have a link and you can jump in and join us this afternoon. Should be a great event. All right, let's talk a little bit about the market and what happened on Friday. Like I said, it was a good day. I would say in the last few hours, things started to change. If you're only looking at the fact that we go up or down, you wouldn't notice this. But if you do follow the groups, industry groups, and individual stocks the way we do, you'll know that there was some underlying changes that took place on Friday. First of all, the Dow Jones and S&P 500 both outperformed the NASDAQ. That hasn't happened much lately. And you can just look at the chart. You see the NASDAQ broke out above its June 8th high. Well, it tried to back later in June. And then, of course, here in July, it's just been going up just about every day. But if you notice the Dow and the S&P, neither one of them have cleared that June 8th high yet because the market's been very bifurcated. We've got some groups that have been on fire to the upside. The FANG stocks have been absolutely crushing it because their earnings are going to grow. In many cases, they're going to grow very rapidly, and we're in a low interest rate environment. Folks are realizing the valuation of companies like that goes through the roof. I've been talking about it all year. But I think there were a lot of people that are in the market over the last few months because the coronavirus didn't think any company was going to grow their earnings, but that's not been the case. We got a big area of the market, mostly technology, healthcare, some communication services, some consumer discretionary, some other areas. I think you're going to see renewable energy post some pretty good numbers. But there are plenty of areas in the market, if you just want to focus on those, that you can make a lot of money in this environment. Now, if you're trading airlines and you're trading hotels and you're trading cruise lines and you're trading gambling stocks and you're trading real estate companies, REITs, yeah, it's been a tough go of it lately, especially since that June 8th top. But those were the groups that were starting to turn around on Friday. And that's why I just wanted to point it out, because I don't know, these rotation things normally don't just happen for a day. So I have a feeling that maybe we're going to see a little bit of that rotation taking place throughout this week. We'll see. Anyway, mid caps, small caps also very strong. Both of them outperform the S&P 500. And I'm going to show you in just a couple minutes in talking technically where some of these different groups stand versus the S&P 500. And you probably already know, but it's not a bad thing to go back over and just reinforce the things that we're seeing. As far as the sectors go, you can see financials, top performer. Where have the financials been? Look at the chart since June 8th. I mean, this is what I was talking about. Things kind of changed, flipped. Financials on top. Energy, next best group. Really? This is the worst performing group. Utilities, third best group. Again, well off its June high. You want to know the two worst groups? Healthcare, which hadn't broken out yet, but been consolidating. Healthcare was by far the best group back in March through probably the latter part of April. Since then, the group's been consolidating. I still think the group's very healthy, but didn't perform well on Friday. Technology. How many times have we seen technology down near the bottom? Technology has been straight up for the most part, and that's the reason why we've seen what we've seen in the NASDAQ. And technology and healthcare, the two worst performing groups on Friday. So that gives you a little taste of what I was talking about in terms of the market rotating and flipping on Friday. The 10-year Treasury yield. Well, let me give you an update here and just make sure we got the latest. All right. 10-year Treasury yield right now, 0.66%. It is up 3 basis points, as I've said, and you can look at what happened to the 10-year Treasury yield. We were up at 0.95 on June 7th. Came down. When did the S&P 500 top? June 8th. I mean, it was right at the top here. Now, the NASDAQ is actually, a lot of those companies are benefiting from the lower rates. I'm not sure that lower rates necessarily are hurting that group. I think what's happening is that as the yields go down, we got money pouring into treasuries. We got money pouring out of many of the S&P 500 companies, but we've also got some of that money going into the FANG stocks and many of these technology, healthcare, consumer discretionary, communication services. Those are still the 4 leading industry groups, and those are the 4 that I would be focused on more on an intermediate term basis. I'm not going to say long term because, first of all, define long term. Are we talking 6 months? To some people, 6 months is long term. To some people, 10 years is long term. If we're talking years and years and years, I think a lot of these companies that are getting beaten up right now will be fine. We're going to get past this. They'll rebuild their businesses, the ones that are able to survive it. But in the more intermediate term, I think the virus is going to be with us, and I think the concerns are going to be there. So we're going to see companies that are doing well in low interest rate environments continue to do well. That's my belief. Now, in the very short term, and I'm talking about next couple of days to maybe a week or two, it's going to be interesting because, if we do continue to see the 10-year Treasury yield move up, I expect we're going to see rotation back into airlines and cruise lines and those companies I just mentioned that have been so weak. That's what happened mid-May to mid-June when you saw the 10-year Treasury yield spike. So money came out of the 10-year and out of treasuries and went into the stock market, and a lot of it went toward those companies that are beaten down. And the reason is pretty simple. 10-year Treasury yield is going to go up when the market feels like the economy overall is going to strengthen. I don't think, listen, we've strengthened off the bottom. There's no doubt about that. We've come roaring back, and it's mostly what I expected that we would do. But we're not out of the woods. And if this virus sticks around for a while, there are many parts of the economy that are going to continue to struggle. So we're going to have this bifurcated action that's going to really in my opinion, put a lid on the S&P 500. NASDAQ may continue going, but the S&P is going to have a lid. When we get this move to the upside, and if we get another move to the upside, and you can see the last 2 days, big reversal there. It was on Friday. That's when we saw the rotation in equities. And then another move up today, I think could lead to continuing rotation in the S&P 500 from the good stocks to the bad stocks. I think some of the bad stocks might benefit this week, or at least starting out, and then we'll go from there. I'm not on a, I'm not ready to just say, hey, everything's fine. Let's go jumping into airlines and we'll be okay 30 days from now. I actually don't believe that at all. I think there are some areas of the market that not only have been severely impacted by the virus, but the road ahead is not clear at all. And some of these companies may have to consolidate. Some of them may have to work out some kind of deals with banks. The government might have to intervene. I don't know. So much uncertainty. And I'm not going in where there's uncertainty. I'm going in where Wall Street's going in. I'm going into the Netflixes and the Amazons and the Apples and the Microsofts, because those companies do very well. They're growing their earnings in this, and they're doing it in an environment that's very favorable for growth. All right, let's keep moving on. Let's move on to talking technically. I'm just going to bring up the S&P 500 here first. So when you look at the S&P 500, this has been kind of the stalemate that we've been in since June 8th, since I just showed you that top on the 10-year Treasury yield. As money has moved back into treasuries, the part of the equity market that has suffered has been those beaten up areas. And so that's why you're seeing the S&P unable to go up. There's a lot of companies in the S&P 500 that are doing extremely well. We got a lot of technology companies in the S&P 500. They're doing great. They're trying to drag the S&P 500 higher. But the S&P, as opposed to the NASDAQ, has a lot higher percentage of all the groups that aren't performing well. So it's this tug of war and stalemate that I'm talking about that's creating this sideways consolidation. So if the 10-year Treasury yield goes up, I think there's a very good chance we're going to see the S&P go up right with it, break out. If the 10-year Treasury yield continues to struggle, comes back down, sideways consolidates, whatever, then I think you're going to see more of this choppiness in the S&P. But that doesn't mean that we don't want to invest, because we've still got some great areas of the market. So essentially, I'm sure most of you are aware, but the SPDR tracks the S&P 500. That's an ETF. You can't invest in the S&P 500 index itself, but you can invest in the SPDR, which tracks the S&P 500 index. So if you pull up the SPDR, you're going to see basically the same chart. All right, now I want to show you on a relative basis the QQQ, which is the ETF that tracks the NASDAQ 100. I want you to look at this over the last year. Actually, we'll go even further than that. Let's go back the last 3 years. And I don't care about the volume. We don't want candlesticks. All right, so let's take a look at this chart. I mean, is there any question whether the NASDAQ 100 is outperforming the S&P 500? I mean, we were already in an uptrend. And in a bull market, I would expect the QQQ to outperform the S&P 500. The QQQ is going to have more high-octane growth companies. And, another way to look at this would be looking at, say, the IWF versus the IWD. This is the Russell 1000 growth versus the Russell 1000 value. Do you notice the similarity? Growth stocks are in favor. And they should be in an environment where growth companies are able to grow their earnings in a historically low interest rate environment. Until that changes, people are just looking at numbers. Oh, Netflix over $500. That's impossible. It's got to come back. Tesla. You see Tesla's over 1,600. Last time I looked, over 1,600. When we put out our model portfolio back on May 19th, you can go back and listen to it. If you're an EarningsBeats member, go back to our webinar page and go to May 19th and pull that up. I remember talking about Tesla, saying at the time it was 800. I said Tesla could easily in 3 months be 1,600. I was wrong. It happened in 8 weeks, 7 weeks. That's the environment we're in. If you can grow your earnings, and you can grow your earnings rapidly, money is going to pour into your company with a low interest rate environment like this. So IWF, IWD, you can see this is visually telling you what's going on in the market. So if we go back to that QQQ spider, I think you're seeing the same thing. Why? Because the QQQ has many more of these high octane, high growth companies, not weighted down by all the poor industry groups. I had looked back, I think I went into the QQQ to look to see the makeup of the various sectors, and 90%, maybe 91% of the QQQ is made up of technology, healthcare, communication services, and consumer discretionary. 9/10. I mean, and those are the groups that are leading. The S&P on the 500, on the other hand, is only made up of 60% of those groups. So when you're looking at the relative performance, that's it. That's what's happening here. Now, how about small caps? How are they doing versus the spider? Spider's on a relative basis awful versus the QQQ. What about small caps? Well, small caps for the last 2 years have been going straight down versus the S&P 500. So there's this hierarchy. You start with the Nasdaq, then you move to the S&P 500, then you move to the Dow, then you move probably to the mid caps, and then to the small caps. And that's how performance has been. So, and if you don't recognize that and don't realize it, then it's hard to outperform the S&P 500, because what's happening is you're probably getting some stocks that are doing really well versus the S&P and other stocks that aren't. And I have a lot of respect for Warren Buffett. We don't share the same investing philosophies. He's much more of a value investor. But the one thing we do share is our feelings about diversification. You know, Warren Buffett, I don't know if you realize this, but I think close to half of Berkshire Hathaway's holdings is in Apple right now. One half, 50%. Who in their right mind would put 50% into one company? Warren Buffett, that's who. Warren Buffett made a quote, and I'm not going to be able to get it exactly right, but he made some quote about diversification and said, again, I'm paraphrasing, but he said something like, diversification is the protection against ignorance. It's somebody who doesn't understand, somebody who's not following the market. I mean, Buffett knows what Apple's doing. I don't know that I'd put 40 or 50% of my money into it, but hey, it's working. And he also sold all of his airlines. That ought to tell you something about the airlines right now. All right, so let's keep moving on. I'm going to just go into scooter reports here for a couple minutes. And I guess the first thing I want to do is just make sure everyone is aware of, you know, the different areas that you can go to get some really good information about scooters at stock charts. And when I'm talking about scooters, I'm not talking about things you jump on and ride around your neighborhood. I'm talking about stock charts technical rank. That is a formula. You know, all formulas have limitations. But this formula was developed by John Murphy. I follow John Murphy. You know, if there is anyone in business that has kind of really shaped my strategy in the stock market, it's John Murphy. Read his books. I'm very much self-taught, but I've applied a lot of intermarket relationships that John taught. I've added my own, but he's been a huge influence. And John came up with this formula, and you can go into I'll just pull it up for you. If you go in here and you type in, we can just type in scooter, and then go into chart school. Show me all chart school articles with scooter. Here it is. There's stock charts technical rank. If you want to learn more about it, and I think it's powerful. Anything that shows relative strength, I think, is worthwhile. Some might be better than others, but anything that shows relative strength is better than not looking at relative strength. Relative strength is very important in the market. So this is a system designed to produce a numerical score that ranks a stock within a group of stocks or an asset class. So for instance, when you're looking at Apple and it's got a scooter score, Apple is being ranked against all other large cap stocks. If you get a small cap stock and it's got a rank of whatever, it's being ranked against all small cap stocks. It's not being ranked versus its industry, versus its sector. It's among the size of the companies. Okay, so that's the first thing to understand about the scooter. Now, there's a calculation. I'm not going to go through and try to explain in math terms the calculation, but the big thing to understand is that essentially, when you look at the rate of change. Rate of change is pretty important in this calculation. 125-day rate of change. So you're looking at where you stand today versus where you stood 125 days ago, which if you figure there's roughly 20 to 22 trading days in every month, you're basically talking about a 6-month look back period. Okay. The medium term indicators use a 20-day rate of change. That's just looking back the last month. So 45% of the entire scooter calculation is based on the rate of change over the last month or 6 months, a little bit skewed more towards 6 months. So that's why I always say probably the biggest limitation on the scooter is that it only is really comparing stocks versus other stocks in their asset class over the last 5 to 6 months. You could have a company that has a 99.9 scooter score, which says, hey, this is one of the best stocks out there. Yet it could have been a stock that 10 years ago was 200 and today it's 10. Why? Because 6 months ago it was only 6. Now it's 10. So it's had a really good 6-month run. Does that mean it's the best stock in the market and that I should be pouring all of my long-term money into it? No, that is a limitation of the scooter. So make sure you understand that. All right. If you want to read about it, Stock Charts has such a great educational area with its chart school. Take advantage of it. A lot of really good information here. Arthur Hill, who's a really good friend of mine, developed most of this, and he is as well schooled in technical analysis as anyone I know. I mean, we have our conversations. I can ask Arthur anything about any topic, any technical analysis topic, and immediately get a response back. He knows exactly what everything is. It's amazing. But anyway, he wrote all this. Check out Chart School if you haven't already. All right, so let's go back over to the dashboard. Now that you know a little bit more about scooter scores, you can see here's large cap. I always keep this on my dashboard. Large cap scooter report, mid cap scooter report, small cap scooter report, just because it's a really quick analysis of what's going on in terms of relative strength. Now, if you get a stock that's already in the 90s and you're looking at the top moves up, like if we do top up moves, well, it's not going to be, you can't have a big move to the upside if you already have a high scooter score. So most of the stocks you see on the top ups, you're not going to see really good companies. You might see companies that are beginning to improve, but you're not going to find Netflix on here. You're not going to find Tesla on the top up because it's already there. It's already at the top. It can't go up any further. Now, if all of a sudden something huge happened to one of those companies, you might find it on the top down because usually you need a high scooter score to have a big drop. But anyway, you should be playing around with this to understand a little bit more about how these stocks are ranked and the changes that are being made. And if you don't see the scooter score on your dashboard, it's because you don't have these different things checked. So additional data panels is not checked. So if it's not checked, there it went. It just disappeared. So when you go into this gear shift there, make sure that you have your additional data panels, scans and alerts, chart list, and commentary, whatever you want. Make sure that they're checked. And then there they are. They're back up there again. All right, the other thing I'll just point out about the scooter scores, in addition to getting information there, I mean, you can see here the top 10 in each of the category. Well, I guess the market's getting ready to open, but we haven't opened yet, 6 minutes. But you can see right here, we got Tesla, the top one, Dexcom, eBay, Amazon, NVIDIA, Netflix, PayPal. That's Tractor Supply, West Pharmaceutical, and Regeneron. I can tell you that 1, 2, 3, 4, 5, 6 of these 10 are in our portfolio somewhere. 6 of the 10. Looking over at this list, I can tell you 2 of the 10 are in our portfolio. I don't know if any of these small caps are in there. No, none of these small caps. But just look at that. That's 8. We have a total of 39 stocks in our 40 portfolios. 8 of them are represented in the top 10 scooter scores. I mean, that's what we do. We look for a relative strength. So anyhow, just wanted to point that out. And then the other thing where you can go is over under member tools. You can go down under the summary pages, scooter reports. And this is pretty cool because it's not just giving you the top 10. You got it in scooter order, you can just go all the way down. Just scroll all the way down. You could go all the way down to 0 if you want on the scooter score in each category. You just switch it, mid cap, small cap. ETFs. ETFs are ranked. And then you can sort it by change. Which ones have changed? Here's the one that's come up the biggest, S&P equal weight materials. That was the biggest move on Friday. Now I can change it and say, give me the biggest moves for the last week. And there you have it. This one was up 50%, the rare earth strategic metals. So much information. So make sure you check out the scooters at Stock Charts. All right, earnings spotlight. I just wanted to point out a couple of these companies that have recently reported, because this gets back to the earnings sneak preview event that we're going to have later today at 4:30. Let me show you, and I said this before these companies came out with their earnings, and I'm not always right, believe me. But we do get a lot of clues from what's going on in the market. Walgreens Boots Alliance here was in a downtrend. Market's been going up. Before it came out with the earnings, it was down close to its 52-week low, even though the S&P's been going up. Look at drug retailers relative to the S&P. They were already at a 52-week low before Walgreens came out with their report. Look at Walgreens relative to the S&P, 52-week low. Walgreens relative to the drug retailers. The retailers are already bad, and this is one of the worst ones. So what do you think is going to happen when they come out with their earnings report? You think they're going to report good numbers? If they were, why wouldn't Wall Street be buying the company? This is telling us that the market is frowning upon Walgreens. And so what happens? Walgreens comes out, misses their earnings, and look at the stock gap down after earnings. All right, now let me give you an example of a different story. How about Helen of Troy? Helen of Troy was rising since the March low. Helen of Troy, relative to its peers, has been rising really for about the last 8 months. It is now breaking out, even before its earnings, was breaking out to 52-week high versus the S&P. Its peer group has been going up for the last 3.5, 4 months. So you see the different picture? Helen of Troy came out, they beat their earnings, gapped up to a 52-week high. It's important to see what's going on in the market, especially on a relative strength basis. All right, couple upgrades, downgrades. First, we're going to take a look at a couple of upgrades. CTSH upgraded today. Nice accumulation distribution. I see maybe a little bit of an ascending triangle. Breakout above 59, 59.5 here would be very bullish. Relative strength, it's come down quite a bit off of its earlier highs over the last 52 weeks. CTSH versus the S&P, not very good, and its peers, not very good. So I would probably not have any interest in this stock, even though, maybe if it gets a breakout and we start seeing improved relative strength, but that's what I need to see on the chart. I don't want to get into it and then hope those things happen. The market is telling us that they're not happening right now. Another upgrade, this one made me laugh, Tesla. So Roth Capital comes out and upgrades Tesla today from a sell to a neutral. All right, now the stock has just run from 950 to 1,500, and let me see where we are here as we get ready to open. It's up 113 points today, another 7%. It's up to 1,658. It was at 900 7 or 8 days ago, 950, 7 or 8 days ago. Okay, so Roth Capital comes out and says, oh, we're going to move it up from a sell to a neutral. Okay, thanks for that timely advice. But get this, their new price target, 750. I can't make this stuff up. 750. Why would you even move it from sell? I mean, seriously, stocks at 1,600 pre-market, you're going to upgrade them and give them a price target of 750? Some of the stuff that comes out of Wall Street and these analysts, I just shake my head. I honestly do. All right, couple of downgrades here. Let's see. Denny's, DENN. Denny's downgraded. Look at the accumulation distribution. Awful. Look at the stock breaking back down near a 3-month low. Relative to the restaurants, not good. Relative restaurants to the S&P, not good. Yeah, I agree with this downgrade. I don't see any reason to be jumping into Denny's. If you want a restaurant, look at Wingstop, look at Chipotle. Companies that are actually outperforming the S&P 500. Stay away from these stocks that just keep drifting lower and lower. One other downgrade, Lennar. I was kind of surprised that Lennar got a downgrade. It is up against resistance, so maybe short term, maybe it struggles, although I think we're going to get a breakout. I see, Lennar breaking to a new 52-week high versus home builders. It's been relatively outperforming the S&P now for 4 months. Any kind of a move down with this downgrade, I think, is a buy opportunity, actually. All right, in the 3 you must see, I'm just going to give you a couple of the FANG stocks. First is Facebook. Facebook, market just opened. Facebook gaps up. I'm going to show you the weekly chart on Facebook. In fact, I'm going to show you the weekly chart on a lot of these stocks. Facebook went sideways for 2 years. It just broke out in May, and then with the recent scandal with Facebook and Twitter, the stock went back, hit its rising 20-week moving average, and it's now broken out again. PPO, weekly PPO is very strong. I think Facebook looks great. I don't see anything technically, no reason why I wouldn't buy. Netflix, another one of the FANG stocks. Keep in mind, again, this stock went sideways for 2 years. You might be looking at this and saying, well, it's going up too much. I don't believe that at all. I think this is a stock that's going a lot higher. I think the whole pandemic really has just fallen into their lap. Think about what they do. I mean, it's home entertainment. Binge watching. Everybody's at home. Well, not everybody anymore, but we still got a lot of people working from home. Still got movie theaters shut down in most parts of the country. Netflix is set up for this. So I would still continue to like Netflix. And then the other one is Google. When you look at Amazon and Apple, they've been going up and up and up for a long time. Google has, for the most part, been going sideways. We got the breakout, and I think Google was poised to go a lot higher back at the beginning of the year. But then this happened, the pandemic. Stock went all the way back down, tested this support area, and now it's breaking out again, just now breaking out again. Look at the PPO. Looks great. So I know there are a lot of folks out there that don't think these stocks are going to go any higher. I think exactly the opposite. We're going to get pullbacks, but these stocks, in my opinion, are heading higher. Anyhow, let's go ahead and take a quick look at the market, and then we'll wrap this up. We got the Dow up 230. Let's see, NASDAQ. NASDAQ's actually outperforming a little bit so far. We'll see whether or not that holds up throughout the day. But this is a good start to the day, no doubt. Everybody have a great day. Make sure you check out the EarningsBeats site if you're not a member already. Again, after 4 o'clock, we'll open this up to the public, the room. It's free. You just come on in, and we're going to talk some earnings coming up, upcoming earnings. Anyhow, everybody have a great day. Be back tomorrow over at stockcharts.com. Happy trading, everyone.